Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my 33-question research checklist. Today, we're shining the spotlight on Manhattan Associates, ticker symbol MANH, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. We'll start with my investment checklist and database. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. To date, I've screened 216 stocks across 9 sectors and 68 industries. The mean quality score is 59%, with a standard deviation of 15% and a top quartile benchmark of 70%. 27% of companies pass this top quartile benchmark, 58% earn a watch, and 15% fail. In terms of market cap distribution, 69% of companies analyzed are large caps, 19% are mid caps, 12% are mega caps, and 1% are small caps. We also have broad sector distribution, with no sector greater than 20% of analyzed companies, and consumer discretionary is the highest at 19%, and 4 are tied at 6% for the lowest. Now, in terms of Manhattan Associates, I evaluated them in November 23, and data used for this episode is as of their latest quarter, Q1 25. They earned a 72% quality score, which is in the 79th percentile overall and 71st for their sector. This is a pass. I'll now provide a comprehensive overview of their business. First, classification of market cap. So they're considered a software system and application industry company within the information technology sector. And then as of May 7th, their market cap is around 11 billion, which is right around that mid to large cap separation line. While Manhattan Associates is not a household name, in supply chain tech circles, they're considered one of the top software vendors, and they quietly power some of the biggest names in retail and logistics. Let's now talk a little bit about the company background and what they sell. So they were founded in 1990 in Manhattan Beach, California, and moved their headquarters to Georgia in 1995. They started out solving warehouse management problems, but have evolved into a comprehensive platform for omnichannel commerce and supply chain optimization. The game changer was their shift to Manhattan Active Platform, which is a cloud-native, versionless architecture offering that provides a unified approach to supply chain commerce. Manhattan delivers value to its customers by optimizing the supply chain and inventory management, saving more in time and money than the cost of its software. Some of its core offerings include supply chain execution, which is their warehouse and transportation management systems. You'll hear the terms WMS and TMS often used. They also do omnichannel commerce, so order management, POS, and customer engagement. They then have supply chain planning, which helps customers with demand forecasting and inventory optimization. And then, as I mentioned, the new Manhattan Active Platform, which runs on Google Cloud and is embedded with AI and real-time updates. In terms of their customer base, this is an enterprise B2B business, and they serve global retailers, wholesalers, logistics providers, as well as manufacturers. Notable clients that I found include Home Depot, DHL, and CVS, which was cited in Morningstar's latest report. And they are considered a tier 1 software vendor as far as capabilities. I think there's also a tier 2 and a tier 3. Then in terms of customer concentration, the top 5 customers accounted for just 12% of total revenue in 2024, and none individually over 10%. So Manhattan has a low customer concentration risk. Let's now talk a little bit about their revenue model. First, revenue generation. So Manhattan earns revenue through cloud subscriptions, which are recurring multi-year SaaS deals, and professional services, which are non-recurring and more implementation-based, as well as maintenance, which is recurring support on mostly legacy licenses. There's also been a SaaS shift So cloud subscriptions have grown at around a 50% CAGR since 2014 and now make up around 30% of total revenue. Manhattan is clearly moving towards a recurring revenue model, which should boost predictability and valuation. We'll then briefly discuss revenue recognition. So for subscriptions, revenue is recognized over time. For services, which are project-based, it's more based on time and milestones. And then hardware, they mentioned that they recognize this at delivery. We'll round out this little section here with some revenue drivers. So there's 3 things that I've listed to pay attention to for revenue drivers for Manhattan. The first and perhaps most important is what they call RPO, or remaining performance obligations. You can think of RPO as booked, but not yet recognized revenue. And for Manhattan, it's over $1 billion and mostly cloud subscriptions. The second revenue driver is their cloud subscription growth, which is actually an area of the business that they see overtaking services within the next few years. And then lastly, international expansion. This is also a big revenue driver for them. So now let's talk about business segments and geographies. They have 4 segments, but really only 3 need attention. And they are services, which I've mentioned are consulting and implementation, mostly non-recurring. And right now it's the largest segment at around 50% of total revenue. Second, we'll discuss cloud subscriptions, which is recurring, the second largest segment and its largest growth driver, although it is worth noting that growth is slowing down from those 30% plus growth rates of the past. There's then also maintenance, which is a recurring low churn business segment, and it reached a peak in Q4 23 and has been on a slow decline since. The fourth segment, which we won't spend a whole lot on today, is software licenses and hardware, which is in structural decline and a very small percentage of total revenue. Before talking about geographies, let's talk a little bit about cyclicality and seasonality. Cloud and maintenance are steady, but services is a cyclical area of the business, with growth ranging from negative 16% to plus 24% over the past decade. And services revenue reflects that enterprise buying cycle, where there's gonna be some boom years and pullbacks. And the growing SaaS base should slowly help with that volatility over time. As far as seasonality, no seasonality was directly called out in their 10K. Okay, let's now talk about their geographies. So in 2024, Manhattan generated 77% of revenue and 64% of operating income from their Americas geography. They also generated 18% of revenue and 28% of operating income from EMEA. There's also a third segment, APAC, which had 5% of revenue and 8% of operating income in 2024. So while the Americas remain the largest market, EMEA and APAC are growing faster, both up around 15% year over year in 2024. Profitability is even more interesting, as APAC had the highest operating margin at around 44%, followed by EMEA at 38%, and America at the lowest at 21%. Over the past 5 years, international regions have not only outpaced the US in revenue growth, but they've also delivered better margins, which to me suggests future upside as global adoption scales. One thing I found interesting is that in Morningstar's latest report, they specifically call out international expansion as one of Manhattan's key growth levers. And when your smallest regions are also the most profitable, you've got some nice tailwinds ahead of you. We'll now discuss their moat. So Morningstar assigns Manhattan a narrow moat, and I do tend to agree. The moat stems mostly around switching cost, as their software is deeply embedded in their customers' day-to-day operations, from fulfillment to transportation to inventory visibility, reducing the need for multi-vendor integration. Now, according to Morningstar, this sticky platform architecture is a critical driver of long-term retention. Unfortunately, I don't believe Manhattan Associates reports retention rates, but it sure would be good to know. Morningstar also highlights a few other areas that form their small moat. The big one, or more important one, is their IP. So from its versionless Manhattan architecture platform to its developer toolkit and proprietary algorithms, it does help create those real switching costs by enabling clients to build custom workflows without breaking future updates. There's also a really smaller aspect, brand power. And I list this because while Manhattan is not known by many consumers, in their industry, they're actually well known, and they're a 16-time Gartner leader in WMS and have repeated leadership in all of their core segments. Now, despite those high switching costs, strong IP, and a little bit of brand power, myself and Morningstar don't believe that they have a wide moat, because I think they lack platform network effects. They face credible competition from firms like SAP and Blue Yonder, and they still rely heavily on complex service-led implementations. Next, let's talk a little bit about their marketing and pricing. For marketing and sales, they have a high-touch enterprise selling system with 9 to 12-month sales cycles outlined in their 10K. So it's a very long sales process. And this is led by their in-house team, although they note they often partner with Google Cloud, Accenture, and Deloitte for implementation and deal flow. Their marketing strategy is mostly based around account-based marketing and major events like their annual Momentum Conference, along with strategic content for Gartner recognitions and Forrester as well. Now for pricing, I've rated their pricing power as moderate to strong. I don't believe they compete on price, but more so reliability and integration depth. And I don't think most clients buy Manhattan to save money, but rather to actually use it to make money, which then leads me into why I believe their price elasticity is a little bit more inelastic than the average company. And for large customers, at least, Manhattan's tools are mission critical and represent a small share of total SG&A spend. So I believe this gives the company pricing flexibility, especially on renewals and expansions. The key thing I think about here is when your platform controls how Home Depot fulfills their orders, your pricing strategy is leverage, not a liability. Let's round out this business overview by talking about their research and development. Every great company reinvests in itself, but not all R&D spending is created equal. So I like to break it down into 3 areas. 1, how much they spend in absolute dollars compared to peers, R&D as a percentage of revenue, and how efficiently they turn that R&D into growth, which I call R&D efficiency. So Manhattan Associates has been a disciplined, high-impact R&D allocator. They've steadily invested around 13 to 15% of revenue into R&D each year, culminating in $138 million in 2024. Yet, unlike many enterprise peers, that spend has actually translated quite well into real revenue growth. Over the last 3 years, Manhattan's R&D efficiency, which is revenue growth divided by R&D percentage with a 1-year lag for R&D, it averaged 1.14, which is nearly double Oracle's 0.55 and slightly ahead of Descartes' 1.13. In other words, Manhattan is getting more revenue bang for every R&D buck. Now, Oracle's spend is much bigger at $9.4 billion or around 17% of revenue, but its R&D efficiency is muted due to its size and slower growth. The Descartes Systems Group spends less in absolute dollars than Manhattan, but slightly more in percentage terms with around similar efficiencies. Okay, let's next discuss the industry. As we know in this podcast, an attractive industry is as important as an attractive business. I give Manhattan Associates global supply chain management software industry an attractive rating. Now, this industry includes warehouse management systems, transportation management systems, order management systems, and broader supply chain planning tools. The industry has benefited from structural tailwinds like e-commerce growth, increasing complexity of global logistics, and a growing demand for real-time visibility. In my opinion, this doesn't appear to be a winner-take-all space, but scale and integration do create barriers to entry, and customers tend to be sticky once implemented. So switching costs are high, and the sector is increasingly becoming mission-critical, meaning lower threat of substitutes. As the new CEO Eric Clark put it on the Q1 25 call, the addressable market is expected to grow at or close to a double-digit CAGR for years to come. I'm always looking for industries with embedded need and recurring upgrade cycles, and supply chain software checks both of those boxes. Okay, so now let's discuss this global supply chain management software industry a little bit more. According to IMARC Group, and they produce a software market report, the global SCM software market is valued at $21 billion in 2024, and it's expected to reach $52 billion by 2033, which would imply a CAGR of 10.6% from 2025 to 2033. Manhattan recently reported $1.05 billion in revenue for the trailing 12 months ending Q1 25, which gives them around 5% of this global SCM software market as of 2024. Now, according to InvestorsGrow.com, analysts estimate Manhattan's revenue to grow to $1.45 billion by 2028, suggesting a 5-year CAGR of around 11.2%, which aligns closely with and slightly above the overall market growth. Let's now discuss the competitive environment a little bit. So I've listed out their competitors as direct and then broader enterprise. In terms of direct competitors, The top ones that I found was Oracle, ticker symbol ORCL, the Descartes Systems Group, ticker symbol DSGX, SPS Commerce, ticker symbol SPSC, and SAP, ticker symbol SAP. For broader enterprise, I've listed Salesforce, Microsoft, ServiceNow, and Monday.com. Let's now look at some customer metrics. So I like to use Comparably, and this data is as of May 25. So there's two metrics that Comparably reports on: one, customer loyalty, and two, Net Promoter Score, or NPS. For customer loyalty, the average for Manhattan, Oracle, SPS, and DSGX is 70%. Now, Manhattan comes in at 68%, and DSGX actually leads at 78%. However, when you flip-flop it to look at NPS, Manhattan is clearly above everyone else, with a NPS of 41 compared to an average with the group of 25. SPSC has a 30 NPS, Oracle has an 11, and DSGX is at 17. While Manhattan doesn't have the highest loyalty score, they do lead the group in NPS, which to me means customers may feel more passionate or enthusiastic about their experience with Manhattan, even if loyalty or repeat usage is more evenly spread across competitors. I'd then like to do a quick financial metrics comparison using finchat.io. Now, running some metrics here, Manhattan Associates leads its peer group in ROIC and free cash flow per share, which showcases its impressive capital efficiency, despite having a lower gross margin than most of the group. While its forward multiples are above all the peers except DSGX, to me, this reflects the market's confidence in its durable growth and strong free cash flow profile. Its 15.5% forward free cash flow CAGR places it solidly ahead of Oracle and close to Descartes and SPS Commerce. Look to X for the full tweet and visual with this breakdown. Next, let's review Manhattan Associates' quality growth profile to see if they are appealing quantitatively. The first section I like to look at is returns and predictability. So here they scored a 2 out of 4. The first question I ask is annualized price return CAGR greater than the S&P 500 since Portfolio Visualizer tracking began? For Manhattan, this is yes. So they've had an annualized price return of 13.6% versus 8% for the market from May 1998 to April 2025. So a good start there. I then have two new questions that I've added to this section. The first one is more of a psychological question, and I ask, are there no more than 5 drawdowns greater than 50% since 2000? And I thought 2000 was a good benchmark since the world changed quite dramatically after 2001. For Manhattan, the answer unfortunately is no. They've had roughly around 8 drawdowns greater than 50% since 2000, which is way higher than my weighted portfolio average of 1.7. With that said, most of these drawdowns were from 2001 to 2010, and since 2020, they've only had 1 drawdown greater than 50%, and it was actually earlier in April 25. So we're 1 out of 2 so far. The second new question in this section, and I got this, it's a new metric from investorsgrow.com, and he's come up with a formula for calculating a 5-year trailing revenue stability score. So I now ask, is 5-year trailing revenue stability at least 0.84, and the closer to 1.0, the better? This metric actually incorporates both trend and volatility, so it's quite comprehensive. For Manhattan Associates, they do get a yes here, as they have a 0.90 5-year trailing revenue stability score as of fiscal 24. This is above that 0.84, which is actually my 10-year weighted portfolio average. So very impressive revenue stability by Manhattan Associates. I'd then like to round out this section by asking, is the 10-year SBC adjusted free cash flow linearity at least 0.77, which is my 10-year weighted portfolio average? This is actually a no for Manhattan, as it came out at 0.47, which does indicate moderate linearity, but well below my benchmark. The next section, profitability, they get a 2 out of 2. The first question I ask is 10-year average gross margin at least 40%. For Manhattan Associates, the answer is yes. It does meet my minimum benchmark, as its 10-year average is nearly 56%, but it is a little below my weighted portfolio average of 64%. The second question is 10-year average SBC adjusted free cash flow margin at least 15%. And Manhattan gets another yes here. It is 18.6% for the last 10 years. This is also a little bit lower than my portfolio weighted average of 22%, but still more than enough for my benchmarks. Encouragingly, both gross and free cash flow margin standard deviations are lower than my portfolio's weighted average. The next section is growth and conversion, specifically around revenue and free cash flow. And Manhattan scores very well here with a 3 out of 3. So the first question I ask is 10-year revenue CAGR at least 5%? And the answer for them is yes. They have a 7.8% CAGR from 2014 to 2024. I'd then like to know if 10-year free cash flow per share CAGR is at least double digits or 10%. And another yes for Manhattan, as their CAGR from 2014 to 2024 was 15.1%. The third question is 10-year average free cash flow conversion, which is free cash flow per share divided by diluted earnings per share, at least 75%. For Manhattan, this is another yes, as their 10-year average is actually 135%, which is well above my 75% benchmark. And it's also worth noting that free cash flow conversion exceeded 100% every year during this time period. So very impressive. I like to round out the quality growth profile section with a look at value creation through ROIC and WACC. And Manhattan scores well again with a 3 out of 3. The first question is 10-year average combined ROIC, which is just an average of stock analysis and quick FS, at least 20%, and is it higher than its 2024 NYU industry database average? This is a yes. Their 10-year combined ROIC was 53%, which is also higher than the 2024 software industry average of 27%. I then like to know, well, is combined ROIC trending up if low, or is it holding steady if already high? And for Manhattan, this gets another yes. They had a period of decline from 2017 to 2021, but combined ROIC has trended upward now for 3 consecutive years. And while it's still below the peak of 2016 to 2017, it does appear to be stabilizing again at a high level. Now, to round out this section, I'd like to know, is combined ROIC consistently greater than their cost of capital or WACC? And this lets me know that they're creating value through their internal projects. For Manhattan, this is a yes. The 2019 to 2024 average spread is an impressive 35% and has never dipped below 20%. In 2024, the industry spread was 17%, so it's encouraging to see Manhattan consistently outperforming that benchmark too. Looking at the full picture, Manhattan Associates does meet my criteria for a quality growth company. They got a 10 out of 12 yeses for this quality growth section. Despite a weaker drawdown history and lower free cash flow linearity, their solid margins, reliable growth, and exceptional ROIC certainly make them a strong contender for an investment portfolio. We'll now dive into a high-level overview of Manhattan Associates' 3 financial statements. First, the income statement. I like to start with revenue, and we have talked about this a little bit, but high level, Manhattan Associates has shown strong revenue stability over the long term, with a 5-year trailing revenue stability never below 0.60 the last 20 years. While there has been some historical cyclicality, particularly in the services segment, the trend in recent years has been more consistent thanks to that cloud transition and subscription-based model. Revenue per employee also reached $224,000 in the trailing 12-month Q1 25, which is above the NYU software industry average of around $65K, but still well below the top quartile of my broader information technology database sector, which is at $870,000. Going down the income statement, I like to then look at margins. Now, gross margins have been remarkably consistent the last 10 to 20 years, hovering between 54 and 60%. Operating margins have also strengthened materially over this time, but have yet to get back to the peak years of greater than 30% operating margins from 2016 to 2017. With that said, 2024 was the 5th year in a row that they have increased. Net margins are in the mid-teens to mid-20s and have followed a similar path as operating margins. Then we'll get into just talking a little bit about COGS. So the largest component of COGS, which drives their gross margins, is a line item called cost of cloud subscriptions, maintenance, and services, which total $470 million in 2024. This line item primarily reflects salaries and personnel expenses, hosting fees, and infrastructure costs tied to cloud and professional services. In 2024, increases were mostly driven by compensation and infrastructure investments, partially offset by lower performance-based comp. In terms of operating expenses, over the past 5 years, all major operating expenses, which Manhattan has categorized into R&D, G&A, and sales and marketing, have declined as a percentage of gross profit, indicating improved operating leverage as the business scales. R&D does remain the largest expense, though it's down from 27% to 24% of gross profit, followed by G&A, which also fell from 19% to 16%. Sales and marketing is the smallest of the three and has remained relatively steady, around 13 to 15% of gross profit. I like the way that they break out operating expenses, and everything makes sense here to me. I then usually like to discuss interest coverage ratio, but they have no interest expense, so we'll move on to the balance sheet. In 2024, Manhattan Associates' top asset was cash and equivalents, accounting for around 35% of total assets. Accounts receivable came in at 27%, just under its 10-year median of 28%. I usually then like to take a look at goodwill, and it's only 8% of total assets, which is comfortably below my 30% threshold and its industry averages, so no concern there. One interesting trend, Manhattan's deferred income taxes have climbed from just 1.4% of assets in 2021 to 12.5% in 2024. That likely reflects timing differences in how cloud subscriptions are accounted for versus taxed, or growing deferred tax assets tied to things like R&D credits. It's not a red flag, but it is something I'll keep tracking to make sure it doesn't get too aggressive. In terms of their liabilities, Manhattan Associates carries no short-term or long-term debt, so there are no upcoming debt maturities or refinancing risk to monitor, which is a major plus in today's rate environment. Their largest liability is deferred revenue, which makes up around 60% of total liabilities, and has consistently averaged above 50% over the past decade. This is a healthy sign as it reflects a strong base of prepaid cloud subscription and maintenance contracts. Accrued expenses is the second largest line item, and it accounts for around 20% of liabilities in 2024. And long-term operating lease liabilities are small and manageable at just 10% of total liabilities, so not really a concern there. What I like here is the clean balance sheet. No debt, strong deferred revenue base. This gives them financial flexibility and signals recurring revenue strength. We'll then discuss 3 financial stability ratios. And overall, Manhattan Associates does appear to be in strong financial health. All 3 of those financial stability ratios, which include debt to equity, cash to debt, and debt to free cash flow, easily meet or exceed my internal benchmarks and industry medians. For debt to equity, Manhattan has maintained a very conservative capital structure with a 6-year average of just 0.12, which is well below my 1.50 ceiling and the industry median of 0.21. For cash to debt, liquidity here looks excellent with a Q1 25 ratio of 4.38, well above my benchmark of 0.75 and the software industry median of 2.64. Over the past 6 years, the average has been 9.78, which reflects a healthy cash cushion relative to total debt. Manhattan's ability to pay down debt from free cash flow remains best in class, with the latest ratio of 0.15, far below the safe zone threshold of 3. Let's now move on to cash flow statement. They demonstrate strong cash generation with a healthy free cash flow conversion ratio well above my benchmark in recent years. Operating cash flow primarily stems from that deferred revenue prior to having fully satisfied cloud subscriptions, maintenance, and service obligations. So on the cash flow statement, there's 2 other metrics I'd like to look at: stock-based compensation intensity and capital intensity. For SBC intensity, I like to ask, is SBC less than 10% of revenue and reasonable versus peers? The answer to this question is yes. While SBC has risen gradually to 8.9% of revenue in 2024, which is actually slightly above the software industry average of 8.1%, it does still fall under my personal 10% threshold. However, SBC now represents over 30% of operating cash flow, which is more than double my 12% portfolio weighted average. So this is something definitely to watch out, especially with the new CEO. In terms of capital intensity, I like to know, is CapEx less than 4% of revenue and reasonable versus peers? And that 4% comes from the NYU database average across all industries. For Manhattan, the answer is yes. CapEx as a percentage of revenue has consistently stayed between 0.5% and 2.5% over the past 4 years, well below those benchmarks. So this reflects a low capital intensity profile, which is consistent with that software business model and a scalable cloud offering. Let's now discuss Manhattan Associates' management and ownership structure. The first thing that I like to do for this section is to identify the stock type. And for Manhattan Associates, I have them as a share cannibal, as they have reduced share count by 16% over the past decade through consistent buybacks that have far exceeded stock-based compensation. And this is despite rarely issuing stock. Next, I like to look into which classification they fall under. And as you may remember, this is from most to least knowledgeable and passionate about the business. And it goes from founder-led, which is the founder still leading the company, to long tenured manager, which is someone who's worked in the industry or for the company at least 10 years. And then a hired hand, which is a CEO with limited experience serving the customer base. In terms of Manhattan Associates, former CEO Eddie Capel, who led from 2013 to early 2025 and had been with the company since 2000, would fit the long tenured manager classification. While the board framed his February 2025 transition as well planned, the timing just before Q1 results sparked mild investor concern and impacted the stock price. Incoming CEO Eric Clark is what I would call a hired hand, as he is an external hire with prior executive roles at NTT Data, ServiceNow, Dell, and EY. He has no prior connection to Manhattan and limited direct exposure to their customer base. I next like to look at employee reviews. They have a 70% recommend to a friend, a 74% approval of the new CEO, and 67% have a positive business outlook. Overall, this is pretty good across the board. I then also looked at Reddit, where sentiment is a little mixed. One logistics user highlighted Manhattan as robust and functional, but warned about configuration complexity and high implementation cost. Integration seems solid if managed well, but the company requires a strong IT partner to maximize value, which is probably why you see Deloitte, Accenture, and some other firms working with them extensively. Let's now discuss executive compensation, and this is more important if insider ownership is low, which is the case here. So Manhattan uses a traditional mix of base salary, annual cash incentives, and long-term equity grants. In 2024, 86% of the CEO pay was performance-based. Executive annual bonuses are tied to 3 financial metrics: what they call a target revenue at 25% weight, new cloud bookings at also a 25% weight, and then adjusted operating income, or AOI, at 50%. For 2024, executives earned 127% of target bonuses, with AOI and revenue hitting maximum thresholds, while new cloud bookings underperformed as it contributed just 6.5% toward the total bonus calculation, which is well below the potential 25% weighting, indicating that it fell short of internal expectations. Long-term equity awards are split evenly between service-based and performance-based restricted stock units, or RSUs, and they use the same financial KPIs. These RSUs vest over 4 years and are designed to align with shareholder value creation. Overall, I actually like the metrics they chose, and it seems like a pretty good compensation structure. Now let's talk about capital allocation. Morningstar gives them an exemplary rating, and I would agree with this assessment. The company maintains a debt-free balance sheet, generates high returns on invested capital, and consistently reinvests in R&D and cloud innovation to support future growth. It does not pay a dividend, which I think is appropriate for a company still in its cloud growth transition, but it does repurchase shares opportunistically, reflecting that disciplined capital return. Notably, Manhattan is also not acquisitive, underscoring its focus on that organic growth. I'd now like to touch on 2 things: shareholder distribution and shares outstanding. For shareholder distribution, this is just buybacks plus dividends divided by free cash flow. And over the long term, I like this less than 100%, so free cash flow can be used for other things. And Manhattan has a 10-year median shareholder distribution to free cash flow ratio of 96%, which is right below that 100% threshold. So this indicates disciplined capital return and preserving cash for that reinvestment. In terms of shares outstanding, I want to know if diluted shares outstanding are declining or holding steady over the last 10 years. For Manhattan Associates, this does get a yes, as diluted shares outstanding have declined consistently from 74 million in 2015 to 62 million in 2024, reflecting a shareholder-friendly capital return strategy via buybacks. To round out this section, I like to look at insider buying and selling. And insider trading at Manhattan Associates tells a fairly neutral story. While recent quarters show net positive activity, most of these insider quote-unquote buys were equity awards, so not open market purchases. Over the last 12 months, insider selling has definitely outweighed true buying, including several routine sells following RSU vesting and those leadership transitions. We'll now briefly move on to ownership structure. I like to look at insider ownership and then institutional ownership. For insider ownership, I want that to be at least 10% ideally. And Simply Wall Street has it at less than 1%, while Guru Focus has them at 1.94%. And this does not pass my benchmark. Institutional ownership, however, does pass, as Simply Wall Street has them at 99%, and Guru Focus is very similar. My benchmark here is 75%. So a little bit low on insider ownership, but very high on institutional ownership. Overall, management's effective stewardship and clear focus on profitable cloud growth support confidence in the company's long-term strategic execution, although the transition to a new CEO will be very important to watch. Let's now dive into a few key metrics that are critical to monitor this business. And what I like about Manhattan Associates is they actually call out these, or at least the first two, in their 10K. So I appreciate that transparency. The first one is remaining performance obligations, or RPO. And this represents the total contracted revenue that has not yet been recognized. And it's essentially a forward-looking backlog of subscription revenue. As of 2024, RPO was around $1.9 billion, which was up a very healthy 25% year over year, and more than 6x its 2020 level. Sustained double-digit RPO growth signals strong future visibility and healthy demand for Manhattan's cloud platform. The next KPI to track is cloud subscriptions revenue growth. This metric measures Manhattan's ability to grow its recurring revenue base. And in 2024, cloud revenue reached $353 million, a 28% increase from 2023, and up 4x from 2020 levels. While growth has decelerated from its earlier 30% plus pace, these gains do reflect continued demand from retailers modernizing their omnichannel and supply chain operations. Now, they don't call it these next two, but I did want to bring them up as things to pay attention to with Manhattan. First is the rule of 40. This is a common benchmark for cloud companies, and it's calculated as revenue growth plus free cash flow margin. Some people also do EBITDA margin. While this isn't an apples to apples rule of 40, what I did is I combined cloud subscription growth with total company free cash flow margin to get their rule of 40 score. And while this rule of 40 has declined from 94 in 2020 to now 60 in 2024, it's still well above that 40 benchmark. The other thing that you want to pay attention to with Manhattan is their win rates. And while this is not publicly disclosed in regular filings, management commentary often mentions this a lot, and it's an important qualitative KPI to monitor through earnings calls and transcripts. The last section, valuation and technical analysis, will assess Manhattan Associates' intrinsic value and relative value, while also examining key technical indicators for those ideal entry ranges. So Manhattan Associates is a growth stage company undergoing a cloud transition. As such, DCF, reverse DCF, and free cash flow yield frameworks are especially relevant given the importance of long-term free cash flow growth. However, I'll also use EV to EBIT for checks against historical norms and peers. First, we'll do a DCF from investorsgrow.com. Using a 9% discount rate, a 2.5% perpetual growth rate, and 4 years of analyst free cash flow forecast, which is 18 total analysts, Manhattan's fair value is $116, which is 37% overvalued versus its current price of $183 as of May 5th, 2025. This implies a 6 to 7% IRR. Next, a reverse DCF. So this is opposite of DCF, and instead of giving you a fair value, it gives you an implied growth rate. And then you need to see if that growth rate is reasonable or not. In Manhattan's case, they need free cash flow per share to grow between 14 and 18% per year for the next 10 years to justify their current price, assuming a terminal price to free cash flow multiple of 15 and a free cash flow per share starting point of either 363, which is a 5-year normalized figure, or 4.98, which is their trailing 12-month Q1 25. This is about in line with their historical growth rates. Their 3-year growth rate is 18%. Their 5-year growth rate is also 18%. And their 10-year growth rate is 15%. Next, we'll do an SBC adjusted free cash flow yield analysis from Stock Analysis and Investors Grow. This ties valuation directly to the company's ability to generate cash. And in my opinion, it's a strong alternative to the PE ratio. The 2025 forward free cash flow yield for Manhattan is just 1.72%, which is below the company's 10-year average of 2.26% and their 10-year median of 1.79%. So this still reflects a premium valuation relative to historical norms. At a current price of $183 and an enterprise value of $10.9 billion, Manhattan appears overvalued by around 30% compared to that long-term average free cash flow yield. And this is an implied fair value price of around $140. Okay, next let's talk about EV to EBIT and then also a forward EV to EBIT. EV to EBIT is from Guru Focus, and this is a great middle ground multiple that accounts for a company's net cash position or debt position while also capturing profitability. Manhattan's trailing EV to EBIT is 40.8, which is just below its 10-year median of 42.6. That's also cheaper than DSGX, which is at 46.5x, and SPSC, which is 54.3x, but pricier than Oracle ORCL at 28.8x. Now, if that were to revert to its 10-year median, this would imply a stock price for Manhattan of around $188, which is actually roughly 3% undervalued from current levels. For a forward EV to EBIT, I used FinChat, and this forward-looking multiple compares today's enterprise value to next year's projected EBIT, which gives us a snapshot of how the market is pricing in future profitability. Now, as of May 5th, Manhattan trades at a 31.1x forward EV to EBIT, which is 28% below its 5-year median of 43.7x. Compared to peers, that's actually more expensive than Oracle ORCL at 19.3x and SPSC at 25.0x, but it is cheaper than DSGX at 40.0x. For technical analysis, we'll do a little bit of trend analysis, volume analysis, and then examine their short interest. First, for trend analysis, Manhattan Associates recently staged a modest recovery after a steep correction, with the current price of $183 nearly reclaiming its 5-year 20-day moving average of 189, but still trading below the 50, 100, and 200-day EMAs. On the 1-year chart, the stock has been in a deep wedge since the lackluster Q4 24 earnings, but has slowly marched upward post Q1 25 earnings. A bullish crossover between the 20-day and 50-day EMAs is forming, which does suggest early momentum, but the long-term trend remains under pressure. For a little bit of volume analysis, we're seeing key resistance at $197 to $220, with potential support around $140 to $180 based on historical volume. Above current levels, volume thins out above $200, suggesting any breakouts may face less resistance, but could also be prone to volatility. Short interest sits at around 4% of float, which is relatively low and below that 5% low threshold that I have, and bullish by typical benchmarks. So this does suggest limited downside pressure from short sellers, although I'd continue to watch this as there was a 14% increase in short interest month over month. Overall, valuation models for Manhattan Associates range from around 30% overvalued to 3% undervalued, depending on the metric, while DCF and free cash flow based methods suggest a premium valuation. Multiples like EV to EBIT offer some support. The company's SaaS transition appears to be priced in, so continued execution will be key to justifying current levels. From a technical lens, the stock has staged a modest recovery post Q1 25 earnings, and a bullish crossover is forming. However, the stock remains below long-term EMAs and major resistance levels. Execution from here will be strong to confirm any reversal. Let's now finish up with the news section, and I'm titling this Bulls, Bears, and Verdict. So let's first look at the Bulls case for Manhattan Associates and why it could outperform. I have 4 points here. The first is that they're a quality growth standout. They score a 10 out of 12 on my checklist, and they get really high quality scores. They also have sticky mission-critical software with deep integration in enterprise supply chains, high switching costs, and recurring revenue tailwinds from that cloud transition. Manhattan offers durable economic advantages. They also have attractive industry tailwinds. The global SCM software market is set to double by 2033, and their international regions are growing faster and more profitably. So 2 things that are working with them there. They also have tremendous capital discipline. With an exemplary capital allocation rating, no debt, consistent buybacks, and best-in-class R&D efficiency, their financial stewardship sets them apart. Now let's look at the bear case and why Manhattan Associates could underperform. First, they have a valuation premium. Several models suggest that the stock is definitely overvalued, and reverse DCF is implying a 14 to 18% free cash flow per share growth rate, which is a very high bar to reach. They also have some decelerating metrics. The Rule of 40 has declined, and cloud growth has slowed from 44% to now 28% year over year. And it seems like new cloud bookings also underperformed internal targets in 2024. The third point is execution risk. The February 25 CEO transition introduces uncertainty. New CEO Eric Clark is a hired hand with limited experience in Manhattan's niche and no prior company ties. Lastly, they do face some technical resistance ahead. They remain under key long-term EMAs and face that resistance I mentioned between 197 and 220. So what's my verdict? I'm putting them on the watch list, but not a buy yet. Manhattan is a high-quality business with a sticky product and strong capital discipline, but valuation remains rich, and the cloud story faces slowing growth and new leadership risk. I first bought in fall 24 before the CEO transition, but sold after Q4 for tax loss harvesting. After this deep dive, I'm holding off on reentering for now, though I'll keep it on watch. Descartes, which scored well in my comp analysis despite having even higher multiples, also warrants a closer look. My 5-year total shareholder return estimate for Manhattan is 8.7% per year, with modest growth, margin gains, and buybacks offset by multiple compression. A pullback or clearer execution could change the story. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Manhattan Associates both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at Invest091. Join me next when we'll dive into the alternatives asset class. Until then, keep your investments smart.